that you could join us today. So I'm delighted to introduce our host, Amit Parmar, who is a seasoned professional with extensive experience in finance, sales, and operations. As a distinguished alumnus of IIM Bangalore and a key leader at Vienna, Amit's expertise in supply chain finance and innovation will set the perfect tone for our discussion today. Joining Amit are three exceptional panelists. Karishma Suvarna Gadia, a seasoned expert in credit insurance, who is currently serving as a commercial and sales head at Atreides India. With over 14 years of experience, Karishma excels in client management and delivering bespoke solutions for her clients. We also have Ravi Valecha, the CEO at India Factoring and Finance Solutions Private Limited. With over 22 years of experience in corporate and retail banking, Ravi's leadership journey includes significant roles at HSBC and ICICI Bank, bringing a wealth of strategic insights. Last but not the least, we have Mr. Ashish Singhal, the CEO of IBDIC, who is a banking veteran and a certified design thinker with over 25 years of leadership experience. Formerly the MD of CVC Cooperative Bank and Experian India, Ashish is renowned for leveraging technology, analytics, and collaboration to drive innovation in the financial sector. With a stellar lineup today, the conversation promises to be both insightful and inspiring. Over to you, Amit, to lead us to the conversation.
Thank you so much, Akshaya. So first of all, I would like to start with a very warm welcome to Ashish, Karishma, and Ravi, as well as everyone who has joined us in the audience. We appreciate that you have taken time from your busy schedules to join this panel discussion. At Vienna, in our over 15 years of journey, we have been focused on enabling trade credit to support growth of businesses. Besides being India's largest supply chain finance platform, Vienna also has been a GST Suvidha provider since 2017 and has enabled over 15% of e-invoicing and e-bill compliances of the country through our zero downtime API services. As we have been at the crossroads of both trade financing and compliance, we had brought a trade verification service to assist the financial services industry in leveraging the GST systems and managing the scale-up of trade finance in a more cautious manner. Today's panel discussion, we will draw insights through our esteemed speakers on how these developments are addressing industry challenges. And we have speakers from three different domains, from the field of factoring, from credit insurance, and from supply chain as well as deep tier finance. So with that, let me first address my question to Ravi. Ravi has been part of the factoring industry now for well over 25 years and has seen the transformation, how factoring in India has evolved. Ravi, I would like you to explain the audience the evolution of factoring over the last 20 years in India, how the industry has changed, how the processes have changed. That will help us set the context on factoring.
Thanks, Amit. Thanks for having me first on the Vienna webinar. Factoring in India. Now, factoring in India is an interesting concept. It's not that factoring started a few years back. You would be surprised, many audience would be surprised to hear that factoring started way back in 1991, with SBI Factors starting a factoring company that long. And it's also more intriguing that the Factoring Regulations Act itself came about in 2012. So, before the act came into, picture also, there was factoring in prevalence. Now, don't ask how it was being done, because that's a different story altogether, but it was being done. Having said so, jump 30 years or so, factoring since 2012, after the act has come in play, has evolved, made a big journey since then, and has been growing in leaps and bounds. But compared to our economy, the size of our economy, obviously, it's nowhere near what you see the numbers being in the banking and financial services world. Now, what has been the challenges? Of course, you would recall also from your earliest stint in HSBC, HSBC did factoring, SBI did its factoring, and many other large banks did their factoring also. However, these were sporadic instances, possibility of checks and balances not being there and the model being incorrect. So it was more of an evolving phase, I would say. And that's why all of them tried their hand at it and all of them actually shut down, after years. However, after, I would say possibly 2015, 16 onwards, there has been a steady growth And key reforms, including clarifications from RBI on recourse, non-recourse financing. There was ambiguity earlier, so this was clarified by RBI, and thereafter, TREDS came in. Actually, I consider TREDS as a overall heavy growth enabler for the domestic factoring market. Now, obviously, it's not really a factoring; it's a reverse factoring. Nevertheless, it comes under the Factoring Regulation Act, and that's where it has taken its time since 2017 when the first TREDS platform was initiated, and now we see the numbers worth talking about. But independently, also most of the banks, in fact, and the both private and public sector, and also possibly foreign banks, also are doing factoring. The regulations have formed, the enablers have been put in place. Insurance has been a game changer also to a large extent. And since 2021, November, when the IRDA took off the embargo and enabled the insurance to be operated, that is trade credit insurance, we have seen, I'm talking about ourselves, of course, the industry is also seeing, but we have seen an increased offtake. Now, factoring is both domestic and exports. Exports is a very huge enabler for the large, SMEs, and even for the large corporates. The requirement from both these segments is, completely different. Some of them look at it from a financing solution point of view. Some of them look at it from a off-balance sheet point of view, and some of them look from a risk mitigation point of view. So there has been a slow growth, but I guess that since 2017 onwards, the growth has been impressive at this stage at the industry level. The growth at the TREDS level has been mighty, and now you see that many of the banks, including private sector banks and even some public sector banks, wanting to start factoring entities within their banking system, or possibly a specialized factoring entities. The emergence of fintech is another key enabler, is what we are seeing. Supply chain finance has taken up a big, impressive growth, what we have seen in the fintech space. And that same thing is now happening in the factoring space also, with lot many, at least I can see that more and more licenses are being issued by RBI. So obviously, licenses being issued means that there is an interest by the corporate sector to avail the factoring licenses. The banking and financial services professionals are setting up these entities, and which also means that the awareness levels of the customers are also increasing. So that's a long, short story of factoring in India.
Thanks, Ravi. You spoke of credit insurance as a key enabler in the course of recent years. So I would just like to pose my next question to Karishma and understand how trade credit insurance, as an enabler of receivable management, has evolved over the last 1 to 2 decades, and what are the further growth areas that she's seeing?
Thank you so much, Amit. Firstly, thank you for having me on this conference. It's great being here. Just a very quick snip on a Trades. So we're the world's second largest trade credit worldwide. We're a Dutch-Spanish company. We're a 100-year-old company. So we have been doing trade credit for the past 100 years. We're a monoline insurer, so we don't have other lines of business. Trade credit is the only one that we do. We have offices in over 50 countries, and we have an annual turnover of 2 billion worldwide. Trade credit, in a nutshell, is a complete balance sheet management tool where companies are protected against default of their buyers or debtors, which can be for both domestic as well as international trade. Financial inability of the buyer, the debtor, to pay because of lack of funds or insolvency is the peril that we cover. We have been in India now for the last 20 years. We have seen how this journey has moved. When we started, we were the first ones to start trade credit in India. This was back in 2002, 2003. And the only programs we ran at that point in time were factoring programs. So we enabled banks like HSBC, like GTF, Factors, SBI Factors, all of them to avail trade credit and then fund the receivables. Cut to 2010 when the regulation changed and the regulator said you can no longer have banks as your policy holder. You need to have corporate clients only. So the model kind of changed there. One of the main reasons also was, we saw a lot of claims coming in, unscrupulous underwriting. We had quite a bit. As Ravi also said, the Factoring Act came about much later. So we did the product without a lot of guardrails. From there to now, a lot has changed. So 2010, we no longer could have banks as our clients. We moved to a complete different set of clients, which were hardcore corporate clients. And it's been 10 years that we didn't have banks as our clients. It was only in 2021 that the regulation changed again to enable banks to take the policy. And now we're seeing an uptake in factors in banks, NBFCs who are now availing trade credit, which is enabling them to further fund the receivables of their clients. So I think in a whole, I mean, when we look at the economy at large, factoring plays a huge part, and trade credit backed factoring also plays a huge part globally. In India, it's still very nascent. The rules around it are still a little gray. We're still evaluating a lot of it. We're seeing what can be done, what cannot be done. But we're getting there. I think slowly but surely, we all have a few programs that we're running. We're looking to really scale it up. It's still early days, but yeah, a lot is happening in this space.
Thanks, Karishma. Moving on to Ashish. Ashish, we have a well-informed audience here today, so I'm not really going to discuss much on supply chain finance, but given your experience and as you're leading IBDIC, would like to understand what really are the frontiers in supply chain finance or trade finance that the industry has been interested in, what really is holding back the industry in crossing those frontiers. For example, deep tier finance has been one area that IBDIC has been also exploring. So these are the areas we would like you to educate the audience about.
Thanks, Amit, and thanks for having me over. It's a pleasure to be on this panel. I think the interesting piece what Ravi and Karishma mentioned on how it has moved forward in terms of factoring or the various forms of reverse factoring, supply chain, PID, SID, etc. So I think fundamental pieces, which I think Karishma also alluded to, is the fact that ability of the lenders to go and take a credit risk. That's the fundamental piece there. And so far, given the low penetration of credit in India, even if you are part of a larger supply chain, lenders and banks are very comfortable lending to, let's say, a AA, triple A plus kind of a rating. As a result, the tier one supplier gets funding. Over a period of time, last 15-20 years, since vendor management, supply chain management started happening by industrial companies like Maruti, etc., some of those players have become big, and banks are okay to take exposure on them, which means effectively it goes down to tier two. Below that, there are some NBFCs, and like Ravi was mentioning, over the last 4-5 years, thanks to trades, thanks to other fintech, they have, and NBFCs had a good run. So they've been able to take some additional exposure and move down to a certain riskier segment, let's say double B, triple B, etc., or they may not be related, but largely it will be in that piece. So the problem which still needs to be solved for really enabling financial inclusion from a supply chain perspective is, how do you go and enable the banks to underwrite responsible credit for a tier 5 or tier 4 or tier 3 guy in absence of financial information? Now, thanks to you guys and other GSPs, etc., and this entire GSTN ecosystem, there is a lot of data which is available for banks to underwrite there. So one has seen some, as they call it, buyerless credit ecosystems developing, whether it is a pure GSTN based underwriting or GSTN plus bank statement being triangulated and then lending. Those are pieces which are emerging, but those are still naked credit exposures which the banks are taking. So that's one large piece of the problem which need to be solved for. And while we are talking about solving that credit problem through data, the other piece which we are running a pilot as part of RBI Sandbox is a deep tier financing solution, which essentially aims at capturing the payment flows and the invoice flows across the ecosystem, which is a linked ecosystem, one buyer, one seller to a second buyer to a third buyer, etc. And then how do we ensure that the credit rating of a large credit-worthy anchor can give comfort to a bank for lending to a lower tiered guy? So take a simple example, 100 rupees invoice by a large anchor. The tier one guy may have done, let's say 30% value addition. 70% is what he procures from down the chain. Similarly, the tier two guy would have done 20% value addition, 50% coming from lower tiers. So can the banks or the lenders go and fund that lathe manufacturer or a job worker who would have done 5 rupees value addition in a 100 rupees invoice, but the payment certainty is there because it is being paid by the large anchor, creditworthy anchor, and how can we go and lend to him? So that's the system which we are looking at developing through tokenization approach. That's the second big piece which has to happen. The third piece, I think the enabler, and Ravi mentioned about threads growing leaps and bounds in the last 4-5 years. This entire piece that it is mandatory for now for corporates with greater than 250 crore turnover to be on threads, which was earlier 500 crores. And my sense is that it'll, if nothing, it'll easily double the number of entities who will come on the threads platform, right? So that's an important piece. While having said that, I think there's still the challenges which need to be resolved are on how do we make this entire process easy for a buyer, seller, and a matchmaking to happen. Today, it's mandatory that buyer and seller both are on the same platform. And particularly from an MSME perspective, it becomes very tedious that I have to go and onboard myself onto 4 different platforms there. So that's one piece I think which needs to be solved for in terms of interoperability, etc. The second piece from a lender perspective, which need to be solved for outside of the modeling pieces which we spoke about, is the fact that today each of the trades platform has a specific interface on through which they go and do. And a lot of banks have started doing, at least the top few have started doing their own bilateral deals. Then they also routed through the NBFCs or the fintech in supply chain finance. So effectively, they might be managing 5-6 different programs through different channels. And there's no single layer there, which may be required to solve this problem. And the third piece is inherent controls portfolio management. Because today, all the platforms, they take the responsibility of onboarding customers and bringing in business. But they are really not putting that much out in terms of portfolio management, recoveries if required. So those are pieces which are still to emerge in the industry.
Thanks, Ashish. So moving our focus to the risks which are inherent in these industrial domains, whether it is factoring or credit insurance or trade finance, would like to first ask Ravi, in his experience, what kind of frauds have been witnessed so far by the factoring industry, and typically what have been the controls or processes or tools that factors have used so far to avoid or mitigate such frauds.
Yeah, thanks for that. In my initial introduction about factoring in India, I mentioned that most of the factoring companies, banks, started somewhere in 90s and thereafter possibly grew into early 2000s also. And thereafter they shut shop. Now, what was the reason for that is precisely the frauds. In India, that has been the biggest roadblock for the factoring market to evolve. It's not only about frauds. I would say the overall banking system in India also, the number of NPAs, what you see, the huge number of NPAs is not credit default in every sense. It has been, I would say 70% or so has been the siphoning of money or whatever be it, so the intention. Now, how do you prevent intention? Obviously, you cannot prevent intentions. But before, I would say 2017 or 16, there hasn't been any control aspects and there weren't any digital tools which enabled the frauds to be prevented. And that's where most of the factoring companies, banks who started factoring business suffered a big time because of these fraudulent invoices coming in. There was double invoicing. There was no checks and balances. How do you check the genuinity of these invoices? SME to SME trade was prone to huge accommodation risk. So that has been the biggest roadblock. And this is what, across my experience in factoring in India, I have seen both in India factoring as well as in HSBC whenever I was there. It was all frauds only. Nothing else was there. It was frauds, typically in the SME to SME segment, without checks and balances. Now come to 2016 onwards, where GST came into picture. After that, there has been a spate of, I would say, digital tools evolution. And that has allowed us to verify the genuinity of these transactions, verify the genuinity of these invoice verifications, whether these invoices are genuine. There are solutions also available which provides us that, whether this is double finance also. So this has been the journey of factoring in India, and that's where the risk which we have seen predominantly in the fraud space, forgery and accommodation risk has been the most important destabilizers till now. And after 2016, when I said that there has been now reforms, digital tools being available, and this is precisely where the growth has now started coming. So with adequate checks and balances, this evolution has been seen. You would be surprised that 100% of the trades volume gets verified through these digital solutions where they go and verify online, real-time basis through the GSTN portals, the genuinity of these invoices. So that's where the growth has spurred now. And that's where you see that possibly another 5 to 7 years, the growth will be humongous. Thanks.
Thanks, Ravi. Karishma, speaking about credit insurance as a industry, of course, invoices, are the key documents, basis which claims are honored. How has the industry been addressing, the challenges in terms of maybe fraudulent invoices being presented to the insurers for claim processing?
Yeah, so,
And what kind of fraud we have seen so far?
Yeah, so I think for us, we've seen different types of frauds. We see short-term, long-term frauds. We see a lot of shell companies, fake invoices, phantom shipping, impersonation, financial statement frauds is another one that you see all the time. Seller-buyer cahoots, like how Ravi said, is very common. For us, the basic document that we have to check is the invoices, which is what we check on a manual basis. I think with now the tools that are available with the e-invoicing to verify the genuinity of these trades, all of this is then handled in a more digital manner. Imagine having to check hundreds of invoices for the genuinity of it, is how we were doing it. Now, with all of these platforms and all of the tools in place, you're able to do all of this in a much faster manner. I feel for us, but it's also assessing the risk from a very holistic manner, right? So it's a lot of training that we give to our underwriters also to spot some of these structural frauds that you see in the balance sheet, especially when it comes to linking it within our system, all of which was not, which we were not able to do years back. Now, with all of these tools in place, we're able to put those linkings in place and have a very clear roadmap as to how the company has grown, what are they doing next, who are the promoters, what did they hold. With the GST and PAN, you're able to fetch all of this data very seamlessly. So it makes the entire process so much easier.
Got it. Ashish, since you spoke of deep tier finance, this is essentially what we may consider as SME to SME, trade that is being financed. And given the heightened sense of invoice-related frauds that can, happen here, what do you think are the, controls, that could be leveraged in, pushing these boundaries further?
Yeah, I think some of these pieces Ravi and Karishma spoke about. So where does it divide this from a risk perspective into two pieces? One is the entity linked risk, and second is the instrument linked risk. So entity linked risk, whether there's collusion, there is impersonation, fake identity, etc. the onboarding process has to be a lot more better there. One is what you can do in the digital medium by verifying the documents which the customer is giving at the time of onboarding. Second important piece is also the fact that is there business activity having at the premises where it is the shop or establishment or the trade is hosted. The interesting piece there is also because through consent-based mechanisms of GST 3A, 3B, 3C, you can get into the history of trades which have happened. So it is not as if I'm coming on board the first trade with Karishma and I'm trying to collude with her to do a fraud. What is the long history which has happened? And that can be triangulated with the bank statements through AA to see genuinely is the payment for those invoices getting made within a period of, let's say, 30 days, 60 days, 90 days, etc. So those are tools which are there which can help mitigate this piece. The second piece, what we have launched, and Ravi mentioned that today within the trades platform, there is dedupe of invoices which happens so that the double funding can get but at an India level, IBDIC was the first organization which launched a India-wise invoice registry just to ensure that there's no duplication of invoices across multiple platforms which are happening, which could be fintech, which could be factoring companies, which could be banks, non-banks, which could be trades, so that holistically there is one database which is coming into play where we are trying to avoid this risk. That's the second piece. The third piece is still which needs to be addressed is while the e-invoice through IRPs, etc., has been generated, linked it to the e-way bill has the materials, at least for the goods, may not be as much for services, but at least for the goods, have they been delivered? And hence, there are consent-based mechanisms to verify the e-invoice and the linkage with the e-way bill there. So some of those pieces at the industry level will need to get in, because otherwise we've seen in the past also fraudsters or people with fraudulent intent will always take advantage of the information asymmetry which exists within the banking or financial services ecosystem. That needs to come together. And for example, and when we've been talking about this Invoice Hub, which is our fingerprinting solution, so far before Karishma started to mention that it's a trade credit insurance also where they look for double funding, we had not even thought that these are the guys we should bring on the repository as well. So overall ecosystem tends to become complex when you have so much of digital data, and everybody will need to just collaborate together to prevent misuse of these funds. And the moment that starts happening, the point which Ravi was making, from the credit losses have come only in largely in terms of the fraud transactions which have happened. So just imagine if we were to kill almost all of them, then the ability of the lenders to bad deep take credit risk on genuine people who may have bad business cycles, but at least the intention is not to fraud the banking ecosystem, can just improve many folds.
Thanks, Ashish. So, Ravi, back to you. Before we go deeper on, leveraging GST systems for invoice verification, would just like to understand how factors have been managing, proving the genuinity of invoices or the transactions that they are disbursing with the existing, or the historical, processes, and how have those been in comparison to these fresh insights now, which are possible, let's say, through GST related invoice verification services. If you could give a contrast on that.
Yeah, so two aspects to that. One, of course, is the digital means, but the other important aspect also is the regular due diligence. Now, when I say due diligence, many of people, remain looked upon possibly the due diligence on the financial aspects. Just look at the financials possibly and look at the KYC due diligence part only. Now, when I mean due diligence, is possibly looking beyond that aspect also. Even today, many of the global fintechs possibly do not do these things. Is a requirement to visit the factories. Now, what are we doing? There has been instances, believe me, that the transactions, both the buyer and suppliers are sitting in the same room possibly, and transacting. This has been the instance. So where is the primary due diligence which is happening? So this is a very important aspect which is being avoided or possibly not being done by many players who have burned their hands historically, and I know some who still continue to do so. So this is the important aspect. The second aspect is which sector has been more prevalent in the fraud scenario. If you see my history, it has been predominantly the traders. I'm not saying that traders are bad, not all of them, but there has been higher prevalence of frauds in that case. So how do you do these things? So we conduct a paper due diligence, which is the trail, which is basically checking the trade between the buyer and the seller, historical, maybe 3 years track record of that performance. Cross-verifying, as Ashish mentioned, with the bank reports. Now, obviously, the digital tools are there, but we did even on paper when digital tools were not available. We cross-reference the ledger of buyer and seller with the bank statements, and then came about that what is the percentage of dilutions or what has been the rejections at all, if any. The other aspect which is more important is the buyer-seller vintage. How long they have been independently doing without financing or without factoring being there or any other financing tool being there, bill discounting being there. That is an important aspect. The input to the larger corporate or who's buying from them. Where is the goods being used into, what is going into, what is the dependency of these buyers on the sellers? This becomes important. Now, we were all doing these things, but the importance of this due diligence in the buyer-seller connect came about during the pandemic, actually. The pandemic taught us that, how entrenched is the supply chain. That if the chip is not there, the car is ready, but could not be delivered. So that is where the dependencies on building these crucial supplier relationships came into fore. And that's where we also do that due diligence, that how much dependence is there between the buyer and the seller, how critical is the component into the buyer's requirement. Because in a trader, it could be replaced overnight, right? So there is no stickiness into the relationship. Whereas consider auto product. Any auto product going to the OEM goes through possibly 9 levels of validations, because these are critical equipments going into the supply chain and going into the final component, right? So it becomes a mission critical. So these are some important non-digital tools which we assess while assessing the relationship and allowing, giving factoring to the customers. Other digital tools are obviously the tools which we mentioned, that verification and the pre-disbursal through the GST network, how much we verify whether the genuinity of the transactions, the duplication invoicing, whether funding is being done by any other CERSAI is there. So we do verification through CERSAI whether any invoices is being financed by somebody else. This is on the domestic side. On the international side also, if you see, the prevalence has been similar. There has been instances where the LC has been funded, or sorry, the shipping bill has been financed by some other banker, or possibly, this is an important gap today, which through the tools, what we have mentioned, that for the domestic, the verification is through the GST, which is allowed, which is permissible now through the consent-based approach. However, on the export side, there has been little or no developments. The reason also is because there has not been interoperability. There is no global registry. For a domestic transactions, we can rely on GST, but where is the global registry where you can verify? So in each geography, there are coming up developments. There are certain developments in Singapore, London, or various other things which are coming about. Now, the next step possibly will be making it uniform or interoperable across systems, across geographies, which will allow the regulators to connect and possibly form a uniform connecting mechanism. Through possibly the most simplest thing which I could think of is a SWIFT, because SWIFT is used for the international transactions across the globe. So put in place a system, something similar to a GST, which enables you to verify the shipping bill or some unique identifier that this is the genuine transaction and it is not being financed. However, from India point of view, there is an important leg which we verify, You know that for all exporters in India, they need to go through the AD channel, right? And they need to register their transactions on EDPMS. So from a document point of view, we do have this checks and balances being there, that you verify that the transaction is going through the DGFA road recorded on the EDPMS, and the AD code is mentioned through us. And once it is mentioned through us, it could not be financed. But there are loops still there. I would say there are not 100% foolproof. But I think once the digital tools come about, and in next couple of years, I do believe there will be tools which will enable similar to the today invoice verification which we have on GSTN. Similar tools will be available in the next couple of years, which will help exports also to grow. And this will become a more important aspect because India is looking at growing exports. Indian government is looking at growing exports to a very large extent, to 2 trillion exports by 2030. That's the vision. So create that thing. There has to be these checks and balances, and digital is the way forward for that. Thanks.
Thanks, Ravi. So while the use of GST, systems or invoice verification services is still at a very nascent stage, even for a segment like credit insurance, Karishma, how do credit insurers today manage the process in absence of such digital tools? If you can throw some light on the current mechanisms, that will help.
Sure. So, to be honest, I think as compared to the other, financing industries, credit insurance in general is taking a little slowly to all of these digital tools. Today, we still rely on everything that is physical verifications that we give the most importance to. Like Ravi also said, right? They visit the factories to see, is the factory running? Same thing. When we onboard a customer, we always visit the customer. We see his premises. All of that verification today, we're able to do it physically because, again, the books are really small. It is an industry that is just about growing. Once we catch scale and size, of course, we need other mechanisms to countercheck these. But today, for us, physical verification is the foremost important check that we actually do. So for all our customers, we meet all of them to verify the genuineness of it. Now, when it comes to the buyer side, that is something that we don't have control on. That is purely based on the information that we have on hand. For domestic, of course, we're tied up with various providers who give us this information. We have third-party providers who collect all of this information from GST, from other 200 or different touch points that they're able to gather this information. They collate it, they give it to us, and then we take an informed call. When we underwrite buyers sitting overseas, because we have offices in those countries, we're able to do it because of the first-hand information. If I was sitting in India and if I had to underwrite a Brazilian buyer from here, it would be very difficult, right? But given that I have my office in Brazil, who has the local know-how of the market, of the rules and regulations there, we're able to better underwrite these buyers. But yes, today, in terms of how digitalized have we got in collating all of this information, it's still very nascent for us.
Sure. And Ashish, back to you. I mean, would like to understand, while banks and NBFCs are looking to embrace these digital solutions like invoice verification, today a lot of these financial institutions practice a sampling approach. Could you throw some light on what kind of processes they run, and the overheads possible that they face while managing these checks?
See, currently what happens is largely the banks are still depending on the trust basis that this is a good rated corporate, AA, AAA, etc. So from a process perspective, verifying that instrument, I will do 5%, 10% sampling once in a quarter. And the CA certificate seems to be a panacea for there. So you give the details to the CA, he goes, checks, and comes back, etc. Right. But the piece is there's so much more which can be done. And why in a digital age, when even if you're processing tens of millions of transactions, you can actually verify digitally every invoice to know whether there is genuinity or not, both from a DDU perspective as well as genuinity of that invoice perspective. For that, I think because of the fact that they're depending on anchors, etc., they still have a tendency to book not an invoice level, but a factoring unit level or the ledger level, whatever you call, which is bunching of invoices together. So my sense is if they start capturing some of these fields and standardization of fields is done, then the ecosystem will develop a lot more. And also, a lot of lenders, banks, non-banks, when we speak to, they say, no, we look at credit bureau, etc. Now, credit bureau gives you a limit level piece once you have given a limit. But if the buyer seller, they may not default, right? But it's easy availability of funds, and they keep rotating the funds within them. Slowly, it will keep increasing till the time there's a bubble which bursts, etc. And before you realize, it's too late to be able to control. And I remember there's one of the central vigilance report which happened for the period of 14-18 when there was this entire twin balance sheet problem. And they analyzed top 100 frauds in India. And the top 3 reasons there were fake debtors, fake invoices, double funding. And these are all AA, AAA rated corporates, right? And then we know what it did to PSU banks and some of the other banks, etc. So my sense is a lot like on the retail side, a lot of data-led decisioning has started taking place. And invoice financing, in the true sense, is like a retail financing which needs to be looked at. There's so much of data available. And today the techniques are available. You can deploy, we were talking about patterns some time back. Certainly there are patterns with which emerge through the transactions. And on those invoices today with GSTN, you also get HSN codes. What is and if you triangulate that entire data, you can know that this customer normally buys this particular HSN code from vendor A at 100 rupees. Now he's buying from vendor B at 200 rupees. Unless and until there was a chip shortage, which Ravi was speaking about, why would anybody do that in a normal sector? And those are patterns which can easily be recognized with the data today. So, but the entire piece is that lot more digitization of that entire piece from a granularity perspective needs to happen. Onboarding of customers has got digitized, but still it is an FU level transaction which is happening.
Sure, Ashish. And as Ashish gave some actual insights in terms of the quality of data that can be available through verification services leveraging GST systems, would like to get back to you, Ravi, and understand how India Factoring has been also using these verification services, especially in the context of even domestic trade, to ensure that transactions that are being disbursed are all kosher, for your organization.
No, so precisely the same thing. So since 2000, so we were not quite active in domestic, to be honest, from that perspective only because one, the checks and balances were less, the insurance was not available. So double, whammy sort of a thing. So we were focusing only on the large corporates. The interesting aspect is that large corporates can avail financing at the much cheaper cost, right? So from that perspective, the avenues for us were limited on the domestic side. And that's where we were not very active on the domestic at that point of time. Since 2016, the situation has changed. And since the GSTN has come in, we are doing 100% verification of the domestic invoices. And that has given us a huge, huge breather. Like I mentioned, that any bank, financial institution in India who had suffered in the past, we were also one of them. And these were the issues which we faced earlier, because of which our shareholder is a European bank. Obviously, the confidence levels from that point was shattered. But now, with these checks and balances being there in place, with the insurance now also available, and various other initiatives which we are seeing, latest being RBI allowed, recognizing the domestic trade as an operational creditor also. So this is also being coming in place now. And we do expect some other aspects, enablers being coming in place for banking financial institutions, like capital relief also is expected soon, possibly. Once that comes in, you'll see possibly a depth of possibly CCs and ODs of the world in banking system, because for anything on the receivables finance, the banks and financial institutions today, considering under the DP or CC facilities, they consider it as 75% of the funding, right, on the receivables. So why not move the entire receivables, focus on the stocks for the CC part of it and the WCDLs part of it, but the receivables, I expect that once these enablers are in place, most of the banks and financial institutions will move towards factoring, which is more robust, which is more credit robustness is there. You know the trade, you know where the money is going in from, where the money is coming in from. So the siphoning aspect goes down to a larger extent. So these are the enablers which I do expect, and that's what we have channelized, we have leveraged on. To give you a perspective, since 2016, we would have done transactions close to around about $4 billion, both domestic and international, largely being international. We also use the credit insurance, but we also use another mechanism, which is FCI-backed mechanism. Also, FCI is a global chain. We would have done $4 billion plus historical loss of less than $20,000 with these checks and balances being there. Of course, these are the digital checks and balances being there, but the primary due diligence, as Karishma also mentioned earlier, is the physical due diligence of the customers, visiting them in person, making sure their factories are optimum and working. The performance risk is on us, right? The insurance is not writing the performance risk at all or the fraud risk at all. So you are mitigating against the buyer risk, where the Atradius like partner provides you the service. They have global offices. They know the buyers, in and out. Possibly they are assessing on the ground level. The local practices, Karishma also mentioned Brazil. The language is a huge barrier. Spanish, Portuguese, possibly who in India possibly can speak, possibly few people in Goa. Not more than that, right? So this is the important aspect which comes into when you do the due diligence, the details about due diligence, the checks and balances, the local regulations will be different. For example, Brazil is an example which is being used. If you don't serve the assignment in local language, it is not considered valid. Do you know that? So these are certain aspects which come when you have partners who are giving you the credit inputs, who are giving you the local insights also. These help us to make the transactions more secure. Now, why are we making, in fact, our customers do tell us that your operational processes are a little bit more stringent than the regular bank. Bank do not ask. You just give the funding request, the WCDL is out. You give a check possibly or RTGS through CC, money is out. Why do you do so much? I say we are securing your transaction only, for your transaction. And flimsy players who do not want to do, they will back out. It's fine with us. We want to do the genuine transactions. And the genuine customer, believe me, they understand that how we are underwriting and securing their transactions, how we are providing that sort of important aspect of the local nuances of the international trade, possibly the terms and conditions. You would be surprised, even the terms and conditions which is there between the buyer and the sellers, possibly they have not reviewed it over possibly 20 years. We have seen such instances. Marketing team speaks X language and the finance teams whom we speak to speak some different language altogether. So we bring out these nuances, finer nuances to the customers, and they understand that when things go bad is when you get tested. And then comes the legalities, whether you have done checks and balances. Ask Karishma, why would you reject a claim? When you go into the nitty-gritties, you have not followed the checks and balances. That's when the rejection happens. If you do complete that circle loop completely from the beginning, the claim will never be rejected. It will never be rejected on that front. So that's what we bring the capabilities, and we bring in the advisory, we bring in the closed loop interaction with the customers, and believe me, customers appreciate that. So once that becomes an institutionalized in India, I do expect that is going. The factoring is the way forward for the Indian market, and that's how we have grown till today.
Yeah, and just to extend one point that you made, Ravi, is genuine customers, of course, will be fully open to aligning to these controls that financial institutions want to bring in further to scale up services, be it factoring or financing and credit insurance. And though I do kind of hear from my friends in the industry let's say making consent available using GST data, etc. for these services, I think it is a matter of time. I honestly believe that the genuine customers will support that, and it will gradually become an industry ask itself. So coming back to
In fact, if I may just take maybe 20 seconds more, this becomes a huge credit enhancer for the SMEs or MSMEs. We are talking about 40% of our customers in India possibly being MSMEs. They are not getting credit because of collateral. Now, recently in a dialogue with DGFT also, we told them that, okay, why you need an ECGC or an insurance cover, or why do you need a collateral? So there was no answer from the bankers. And this is where we came in and told them that factoring provides that solution, that if you provide the credit enhancers like insurance, which is a risk mitigation, you consider it as a capital relief. So you're providing a win-win solution for the customer, which is MSME. You're providing a win solution for the NBFC. You're providing a win solution for the buyer also. So this all together, if you tie in, the benefit is for the MSMEs who are credit stretched. And that in turn will go to the growth of the Indian economy in totality. This is what we have been talking about.
Absolutely.
Thanks.
Karishma, the last question on this panel discussion to you. How do you see the credit insurance industry embracing services like invoice verification? What kind of process relaxation as well as customer experience improvement you will start seeing by leveraging such services?
So for credit insurance, I think it's going to be a huge enabler. Today, we asked a lot of data from our customers. We asked them on a monthly basis to give us data of all the buyers that they have dealt with. If we are able to enable it via APIs, to just pull the data directly from their systems with the consent, we don't need this back and forth. Also, when it comes to claims, the one thing that we want to know is has the buyer actually acknowledged these invoices? There is no dispute there. So if we are able to connect the two, he has claimed GST on those invoices. Yes, it's already, the loop has been closed. I don't have to go back to the seller and say that, okay, fine, show me some emails where he has acknowledged this debt. Of course, we have to give them, we have to call the buyers and have the conversations with them as to why aren't you paying, when will you pay, so on and so forth. But assuming they, come up with a frivolous dispute, you can very easily go back and say, guys, you claimed GST on all of these invoices. You are now creating something that was not already there. So these checks and balances are something that will enable us to, be so much quicker in claims processing as, tomorrow once we have all of these in place.
Absolutely, Karishma. And in fact, with another recent development in the GST ecosystem, which is, the invoice management system that has been rolled out, mandating buyers to use that for approving invoices against which they would be claiming input credit. That basically leaves digital footprints. That data can get collected, through APIs, through GSPs, and of course can assist the very due diligence that as a credit insurance team would want to check against invoices which are claimed by the policy applicants. So that brings us to the end of this insightful panel discussion. We'd be open to questions, if any, that the audience may have raised so far.
We do have 2 questions in the chat box.
Okay, the first question from, actually both questions from Ayush Parekh, but the first one pertains to recourse factoring. So Ravi, if you can see that on your screen, do you see sellers' insolvency also as a risk in case of recourse factoring?
No, obviously that's an inherent risk, right? In case of a recourse factoring, so that's an inherent risk which any banker, financial institutions will assess before assessing. It's like your banking facility which you assess. So you will do the financial due diligence and the other due diligence on the seller. Having said so, obviously it boils down completely towards what is your seller selection criteria. Delinquencies are always part of this. Is an inherent business risk, right? Which you are doing. A financial institution is part of the credit defaults will always be there. Can we say that it can never be there? It will be there, but how are you going to mitigate against it? What are the genuine transactions where credit issue has come up because of the change in the dynamics of the industry or not, whether you can support these customers, whether or it is an intentional thing. So these two can be differentiated, and then you do the assessment, what has been the history and the legacy of the customers. Having said so, the legal reforms also are important today. The IBCs, what we have seen possibly 10 years back, which was not prevalent at that point of time, the legal enforceability was not there. We, in our experience, since past 5-7 years at least, we have seen that the efficacy of the IBC also, we have had claims or decisions in our favor by the court, both the lower court and higher court also in our favor, where the factoring has been proven both on the seller side as well as on the buyer side. So the efficacy is coming to the fore also now. The enforcement is getting stringent, and with the IBC getting stringent about the seller cannot participate in the buying back of the company or taking the back route, that is also coming to the important aid for the bankers and financial institutions. I hope I could address that.
Thanks, Ravi. And another question from Ayush. Karishma, if you can take that. Do credit insurance companies mandate invoice verification to be done by factoring companies?
So to be honest, we don't mandate it. But what is going to happen is when a claim comes in, that's the first thing I'm going to verify. Were these invoices genuine invoices? Did the trades actually take place? Is there no duplication? Did you happen? So was CERSI registered? All of those checks are going to happen when a claim comes in. So whilst I don't mandate it upfront, when a claim comes in, as Ravi said, there are a million ways that you are going to check to see the genuineness of these transactions. That is going to be checked. Assuming we find that this is a fraudulent transaction, your claim is not going to get paid out. So it is for the factoring companies to do all of this to better protect themselves. Insurance at the end is a fallback mechanism for genuine trades. We're not here to cover fraudulent risk.
Agreed. Thanks, Karishma. If the audience has any more questions, do let us know. Otherwise, you could also write to us, and we will have responses from our expert speakers today made available to you in due course.
Yeah. So I think that's about it that we have on the chat box. So maybe everybody can write to us if they have any other questions, and we'll be happy to address them with our experts. I just wanted to take this moment to say thank you to everybody who joined the webinar, and thank you so much to our panelists. This is a very, very insightful session, and we're so happy that you took the time off your busy schedule and joined us on this webinar with Vayana. Thank you so much.
Thank you.
Thank you.
Pleasure to be there.
Thanks, everyone.
Thanks.
Thank you.